September was a very interesting month for markets and economy. What is becoming more entrenched in the market is that global economic growth continues to slow down. We saw a number of countries whose PMIs, which are purchasing manager indices that measure how the manufacturing sector is doing, continue to decline. Only about 5 countries are still experiencing an expansion in the manufacturing sector. And those 5 countries account for just about 15% of global growth, which means over 70% of global growth continues to decline. And this we have also seen a number of central banks, particularly the US Fed, that came and cut interest rates. The European Central Bank also cut interest rates deeper into negative territory. But for the European Central Bank, they also reinstituted the bond buying program, which is quantitative easing, essentially putting 20 billion euros a month into the economy with no end target. And what they're doing this time around is they're going to look back and say, is inflation at 2%? If not, they continue. So it makes sense to assume that they're going to continue well into 2021, given that their own inflation projection does not reach 2% until after 2021. But also we have other developments in terms of trade tensions between the US and China that continues to rattle markets in reducing volatility. Yes, we've had a partial trade deal between the US and China, but that is not going to be sustainable. It's unlikely to result in a complete or a full trade deal that eliminates the risks that we continue to see. And in Europe, the UK is unlikely to go out of the EU on the 31st of October as it was initially planned for. The more likely outcome is an extension well into 2020, which means we're likely to get a snap elections before the UK comes out of the EU. And that means uncertainty is going to remain in the market for quite some time.